It's Equity News on Equity Access, your aerial perspective on stock market developments and on developments in the Zimbabwean economy. A beautiful evening it is to you. I'm Ibn Mabunda. Let's get started. Our news tonight: following a cabinet sitting today, government says companies can now import their own fuel for their own consumption. This comes in the heat of Zimbabwe's fuel crisis as Zimbabwe grapples with a shortage of foreign currency. Zimbabwe currently demands 49 million liters of fuel per week and spends $3.5 million per day. The Minister of Energy and Power Development, Honorable Joram Gumbo, issued a statement following the cabinet meeting. Let's have a listen.
And also this answer well to the question that followed to say those with their own funds, companies like in the mining sector, farming sector can also import fuel, but not individuals at the moment. So that's where we are at the moment. So that's the situation. And also regarding the issue of diesel versus petrol, it is true that last week there was a big shortage of diesel, and because of that shortage, His Excellency allowed us to use what we call strategic reserves to bring in diesel, just to mitigate in the meantime as we were allowing oil companies to do their usual ordering of fuel into the market. The stabilization of both products and the destabilization is caused by companies bringing in another product and then at the same time trying to bring another one when already a gap has already been created on the other product. So that really at times causes that mismatch. But we hope that come towards the end of the weekend, things will have stabilized for both products.
Thank you. I'm sure when it talks about...
Meanwhile, the price of bread continues to soar. INSCO, the biggest producer of bread in the country, today issued a statement announcing the increase of price of bread starting tomorrow, which is the 6th of March, to $2.70. Well, in February, the Bakers Association of Zimbabwe issued a statement to the effect of the increase of the price of bread from $1.40 to between $2.10 and $2.35, which is a 75% increase. Well, government stepped in to save the day and pegged the price at $1.80. Well, much as government had set that price, it seems as though on the ground that actually did not materialize, with bread being sold for between $2 to $2.60. And now INSCO has come in to increase the price of bread to $2.70, which is the first time that INSCO has actually taken that bold move. Plus, Australian listed Prospect Resources said it has completed plant optimization at its 87% owned Arcadia lithium project here in Zimbabwe. This would allow for the installation of what is called a high pressure grinding roll, an HPGR. Last year, Prospect was granted a mining lease covering the Arcadia lithium mine, which encompasses some 57 claims owned by Prospect Lithium Zimbabwe. Prospect has noted that the HPGR option would simplify the project's processing design, replacing tertiary and quaternary crushers, delivering capital expenditure reduction of some $2.3 million to $163 million. In an interview, Managing Director Sam Hancock issued a statement on the Zim operations. Let's have a look.
We've managed to secure what's called national project status, so we're a project of national significance, and we're currently expecting our application on special economic zone to be reported on. So special economic zone is an incentive process driven by the government of Zimbabwe, which allows projects like ours to operate independently, and there's a raft of benefits that we stand to pass on to our shareholders. The resource is a 43 million ton resource, grading 1.41% lithium, and it's predominantly hosted with spodumene and petalite. So spodumene and petalite are both lithium-bearing concentrates that we'll produce and export. Spodumene is fairly well understood with its production in Australia and predominant exposure to the EV and energy storage. Petalite, however, is really where we see our competitive advantage. Not many operations, in fact, barely a handful, produce both petalite and spodumene, and the demand for glass and ceramics industry is around 30% of global lithium consumption. And in particular, in our case, we have a very low iron content, which attracts a premium. So we're looking to leverage that and ride the stability of the glass and ceramics industry, whilst we hope to expose ourselves to the upside of the EV and energy storage.
Plus, in addition to the El Nino, fall armyworm threatens to wipe out 60% of the 2018-2019 agricultural season where maize is concerned. That, of course, is according to Agri-News. Since the fall armyworm was first detected in Central and Western Africa in early 2016, before spreading in late 2016 and 17 to Zimbabwe and other countries with devastating consequences to both small-scale and large-scale farmers, the FAO Food and Agriculture Organization undertook a project with the government of Zimbabwe through a $500,000 support by the Japanese embassy in Zimbabwe to mitigate the effects of fall armyworm among small-scale farmers as well as large-scale farmers. Said much needed to be done to alleviate the situation and bring resolve to that crisis. Zimbabwe currently demands 1.8 million metric tons of maize. Reserves from prior year are sitting at 500,000 metric tons, while expected production for the 2018-2019 season is expected to be 800,000 metric tons, which totals about 1.3 million metric tons, leaving us with a deficit of 500,000 metric tons. Plus, JSE-listed platinum mining company Implats is planning to boost output at its wholly owned Mimosa mine here in Zimbabwe by 30% as it bets on strengthening prices of platinum group metals. While Mimosa is jointly held by Implats and Sibanye and is located 150 kilometers east of Bulawayo, Mimosa contributes 8% to the group's production. During the 6 months to 31 December 2018, Mimosa contributed a total of 132,000 ounces, down 1.4% from 134,000 metric tons produced in 2017. However, this was a 7% growth in as far as revenue is concerned to $2.3 million in the 6 months to 31 December 2018. For a review on these and other issues, I'm joined in studio by our resident chief analyst, Respect Gwenzi. Respect, good evening and welcome to the show.
Thank you for having me, Ben. My pleasure.
Splendid. Interesting developments that have taken place today, starting with government issuing a statement that companies or corporates can now import their own fuel. Quite an interesting development. What is your take on that?
Yeah, I think it's clearly a seismic shift in terms of government's previously plotted plan to try to lower the impact of inflation. Initially, when government set to increase the price of fuel, they had to select key productive sectors such as mining and agriculture, and they exempted them from, in fact, they offered them a rebate in terms of their fuel procurements, and rebate actually accounts for more than 50% of the going price, fuel price. So in essence, now that they are saying we don't have capacity to adequately supply the market, and miners and agriculturalists and those who play in such productive sectors can now import their own fuel, it literally means they are being subjected to the vagaries of inflation. And if I'm to put a clear rate in terms of what this means in terms of price or cost increase to the producer, if you look at the going price of fuel at $3.30 a liter, in fact, at $3.11
and $3.30
at $3.30 for petrol, and
yeah.
$3.11. About 60 cents or so of that money is actually money that's due to government in forms of various taxations. So if you allow a player to import on their own, it increases or it exposes them to the current market rate. So it means costs will go up for producers such as miners and so forth.
Yeah, I think this is perhaps a positive move, because what we have been doing, respect, is that we've been hiding behind the finger that everything is okay, or at least to a certain extent. But now I think with us facing reality, this puts the fuel uptake or fuel importation right to the corporates, and we can get an assessment of where it is that we actually are.
I want to differ. If we were so clear about wanting to go to a market-based economy, then we should have been eager to re-dollarize the economy. Because essentially they are saying generate your own forex and buy on your own. So if it can be, if national resources, or if all the income or in forex terms can be pulled aggregately, and those who import fuel in terms of the distributor guys, if they could be allowed to charge their fuel in forex, then we could see possibly a cost reduction. Because if each and every player has to put containers outside Zim to source fuel, that essentially increases the cost. But if one player was to bring their own the fuel to supply the whole market via the pipelines, it could definitely reduce cost. So even my take is that I wouldn't necessarily think that government is going towards a realistic appreciation of market forces in the economy.
My argument, respect, would be I wouldn't agree with re-dollarization, because again that would put pressure on government to actually pay civil servants in forex which government does not have. However, I would say that with this initiative, let's then allow a free float of the exchange rate between the RTGS and the US dollar, because the semi-fixed rate will not exactly cut it. That will still put pressure on corporates, and so that would perhaps bring us turbulence on the market. So I would say this is a positive. We are getting to see exactly where Zimbabwe is. From a logical perspective, the first step to dealing with the problem is finding out what the problem actually is, or spelling out what the problem is. So if we get to this point, things get to a place where they blow out of proportion, then we know that we are really in a crisis. Then we can start to take steps to address the problems that we have at hand.
Yeah, if we are to use the current pegged rate of fuel at 311 and 330, that's clearly a lack of appreciation of market fundamentals. Why peg a rate? Why not allow the dealers to determine the rate at which fuel should be sold based on the cost at which they import the fuel? That way we solve the problem to do with shortages and market distortions. So I don't believe there is sincerity on the part of policymakers. Why? Because if you are pegging the price of fuel at $3.11 and $3.30, you are essentially saying you are essentially putting a certain market rate, and yet on the black market the price of forex is actually moving either way, in either direction. So as much as it goes up, then it causes shortages. If it comes off below a certain government pegged rate, then because the implied rate will be 2.5 at the going 3.3 rate. So if the black market rate goes beyond 2.5, where it is right now, then it means there are likely to be shortages. If it goes below 2.5, then we can have some sort of increased supply. So I don't believe there's an appreciation of or trying to solve this on a market-based principle on part of policymakers. It's try and error game, just to say we have a crisis. Producers are crying today. So what do we do? Let's just let them import on their own. But the pure cost evaluation has not been done in terms of some of these policy measures. And I really believe that it has got a significant inflationary impact on the economy.
Well, it sounds like another bootstrapping measure. Let's get on to INSCO. INSCO has released today, if you could back that for me. INSCO has released a statement which says that bread price list, which details the bread price list which commences tomorrow. And there it says that the wholesale price the wholesale price is $2.45 and recommended retail price is $2.70. And mind you, we're coming from a place where we have seen the price of bread scale 4 times over the past 12 months, excluding January and February. I mean, and now we are at a place where we are also seeing them issue a statement that the price of bread has scaled. What would be your interpretation of what's taking place here?
Yeah, it's a clear reaction to the shift in macro fundamentals. Prices going up, the recent increase, the recent floating of the exchange rate. Because what this means is that you are going to be selling in RTGS and you have to procure wheat in US dollars. So what you do, you have to exchange your RTGS dollars into Forex at a certain market rate. And what's that rate? That rate at the present moment is about 2.5. So if you do the maths, you will see that from $1.40 to about $2.50. It might not necessarily be 100%, but there's a clear factoring of such fundamentals. But I think there's been erratic movements lately, government trying to stop such movements. And we hear a few weeks back, government coming in to say we have agreed with millers for them not to increase the price of bread. And yet millers had just announced that their prices are tending towards this price regime that has now been announced by one big player in that market, in that space, which is definitely INSCO through Bakers Inn. So there are really some shifting fundamentals, and government doesn't have to play a hand in that. If they say we should be a market-based economy, we are liberalizing the exchange rate, then companies should also be allowed to charge at an exchange rate-based price for them to achieve a parity as well as profit in terms of their operations. But likewise, all this points to an increase in inflation, because prices have to be adjusted, wages have to be adjusted. Generally, costs in the market have to go up in order to meet the current currency regime. I
also get the impression that, look, this price has been issued before the government has actually allowed or given the leeway to corporates to import their own fuel. So that price, I believe, had not yet...
It's not a fuel-based price. What we are saying here is you already have factors of production.
Correct.
Fuel is critical in terms of distribution of bread.
Affirmative. What I'm saying is...
That's number one. You are saying they did it before government said they should.
Correct.
Do so, which means it shouldn't have been a cost. It should have not had... It should not have been possibly a function of the
fuel.
Increase.
So now...
Of the increase.
Yeah.
Of the increase in price. Since government had not said you are going to import on your own, you are going to be giving you. But I'm saying factors of production go beyond just fuel.
Correct.
There is wheat, which is the biggest component in the production of bread. And that wheat is sourced from outside the country. 3 over 4 is sourced outside the country. So what does that mean? Even the local produce that government promises to secure for these players, it's going to be coming at even higher prices. So that means they have to convert their RTGS dollars because they can no longer get 1:1
right
on the market. So your cost should actually rise
higher than what they've actually given here.
Yeah, it's a function of other factors, but definitely there has to be a movement towards.
That's what I was diving towards.
Yeah, sure. So it's that factoring of macro developments that's coming into play. And if you look at food, generally food has a bigger weight in terms of the CPI, 30%, and bread on its own has got about 9 to 10%. And what that means is we are likely to see that increase in the overall CPI. If you look at the price of fuel again, there's no stability, and there might be tendencies to move the price of fuel maybe even to closer to $4 and so forth. And that also has got an impact of driving general prices upwards. So there hasn't been stability in the market. We haven't established the real rate at which Forex can be secured, the rate at which those who are earning Forex can be selling it to the market. I believe the 2.5 exchange rate is quite artificial, because there hasn't been some real flows, and there's not been any kind of fluctuations to really reflect a pure demand-supply forces movement on the market. So as long as there is not that clear establishment of a real market-based equilibrium, I think we are likely to be seeing these fluctuations, and especially growth in local prices. It will come in through delta and so forth, and when such filters, definitely inflation comes through as well.
Sounds like we're in for a roller coaster ride. And to compound that, we have another situation here that seems to be adding to the Zimbabwe's economic woes. In addition to El Nino, the fall armyworm decides to visit Zimbabwe and threatens to wipe out possibly 60% of Zimbabwe's maize production. But before we can get into the dincy-wincies of that, let's look at our performance in terms of what we have produced over the past, because currently we demand about 1.7 million tons of maize per year, and
specifically, yeah.
Thank you. So, and yet our prior year reserves are 500,000. Our expected production for the year 2018-2019 season, so to say, is about 800,000. So that leaves us with a deficit of 500,000 metric tons. But let's look at where we are coming from. Okay, to 1980, we're producing 2,000. We're producing 2.7 million metric tons of maize per year. Moving on to 1995, where of course I may have forgotten to mention a peak of 2.9 million. That's 1984. 1995, 2000, 2.6 million, and then it starts to vacillate, but of course at a lower tempo. And so at the moment we are at 1.3. Now, that being said, what would be your interpretation or your analysis of the situation that we actually have on the ground?
Yeah, so it's not basically a Zimbabwe problem per se. This is an Southern African region problem. We've been affected by El Nino lately, and 2017, as you can see, was a bit of an exception. A lot of commander Greek coming into play. Good rains and less insurgency of such armyworm and whatnot. So it's going to affect the broad Southern African region in terms of the expected produce. So this year we are expected to do at most 8 from the 2018-2019 season. And if we achieved 2.156 in 2017, definitely that left us with a bit of a surplus. Looking at the fact that we only demand 1.8, it means we had about 300,000 at our disposal to carry over to the next year. So government says in our strategic reserves we have about 500,000 metric tons, and so it may help cushion the decline in expected production, but the deficit still remains up 500,000. So that also feeds into the whole matrix around the inflationary pressures that are expected out of Zimbabwe, because that deficit can only be matched through sourcing from outside. So we either have to import, and as of last year and the previous years, government was the sole importer of maize, and they were actually buying local maize at a certain market rate. And for the imported maize, they would import from Zambia and so forth at prices of about 350 thereabout. So I think it's gonna push the budget deficit upwards, because 500,000 metric tons, if you do the maths at an average of $340 a ton in USD, that gives us a very significant figure. So we're likely to see further pressure on the external trade side. More food imports coming in, and looking at the precarious position where we are sitting at right now in terms of trying to match our imports to our exports, it means further variance between the two aggregates, bar some other factors. So it's really a challenge, and I think going forward, if the status quo remains, it means we'll be in a drastic position.
Well, thank you, Respect, for the perspective. That's it from Review for today. Up next is Special Focus. Stay tuned. Welcome to Special Focus. Joining me for a conversation on an interesting subject is Anyasu Chumvumu, a resident investment analyst. Anyasu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Can't complain, should only get better.
Why not?
Of course, yourself?
I'm all right, my friend.
Beautiful. Let's get the ball rolling. Our special focus tonight is on cotton.
Yes.
Well, cotton is used in clothing, fishnet, books, as well as stock feed. It has various uses. And we're coming from a place where cotton was the second largest foreign currency earner in as far as the agricultural field is concerned. But that has since ceased to be. Now we have actually sugar taking
over,
that very same position. Now, I would like us to just have a look at the stats so as we can know where it is we're coming from, where it is that we actually are, and perhaps try and postulate where Zimbabwe could be in the future, in the years to come.
Yes.
Well, this would be the stats over a period, that 20-year period from 1998 to 2018, and if we were to just have to make an assessment of where it is that we're actually coming from, 1998 we're producing over 500 bales, and then we also moved to 2003, which is just
similar. It's about similar, just a little bit
exactly
below.
Then we move on to 2011, where we reach our peak of about 500. But
700 actually. Yes.
Correct. But here is something that is quite interesting. Our movement in terms of our quantities seems to be in tandem with the price of the commodity in US cents, in particular, moving right down to right where we are. This is 2018, and we just had over 80 cents per bale. Okay, compare that to how other countries have actually performed. We look at Mali, which is the largest producer in Africa. For 2018, Mali produced 1,350 bales, ranked number 10 in the world, while Benin was ranked number 12 with 1,300, Burkina Faso number 13, 1,200, Tanzania 425 bales, while Zambia, our neighbor to the north, produced 200 bales, just like Zimbabwe.
Yes.
Okay,
yes.
So there we have the graphical presentation. They're pegged against the price, and it seems as though that the price seems to play a key role in as far as that is concerned.
Well, I wouldn't like to really peg it around the price and our production levels being low, us trying to match ourselves against the price, because if we do look at the fact that you've got your Mali, which produced as high as 1,350 bales. Now these guys didn't manage to hit on the fact that they could actually match their volumes versus the low price, regardless of the price coming off from as high of about $1.60 US dollar. So with that price coming off down to as low as about 90 cents in 2017, when these guys actually reached 1,350 bales.
Because, that seems to be their peak.
Yes, that seems to be a peak. Now these guys managed to cover the gap between them actually having a lower price and having a higher output, which then gives them a good margin in terms of their profitability. So I wouldn't really peg our productivity now, but I would say that our productivity has much to do with a lot of mechanization and to do with a little bit of funding within the industry. Now the industry has been lowly funded for a couple of years, going back to the days where we used to be able to make about 450 bales thereabout. We haven't had much funding in that area of agriculture. I think there was not a lot of confidence, especially to do with there being less farmers in the industry. Now, with less farmers in the industry, there was not much appreciation of how cotton was of value to a lot of agricultural personnel. Now, a lot of agricultural personnel then shifted from doing cotton farming into things like maize, into other products like tobacco. So that then depleted the amount of people that could actually produce a high number of cotton, because I can't really blame it on weather, because cotton is pretty much almost a drought resistant product. If you look at the high producing countries like your India, your China, your Burkina Faso's, your Mali's, those guys are in a high temperate area, climate, yes, high temperature climates. So we can't really blame it on weather per se, but then we've had somewhat of a very good weather, and even if you look at the geographical area of where Zimbabweans normally do their cotton farming, it's in the low velds where you find those kind of high temperatures and low rainfall patterns. So climate and the like wouldn't be much of a blame in terms of our productivity, but I would say that we haven't had much cotton farmers, not a lot of funding in that area. And yes, because you will realize that when we had a lot of funding in that area, which has actually recently coming in from 2016 to 2017 and the 2017-2018 farming season, where there was a lot of command agriculture that then aimed at a lot of small scale farmers. There was a tune of an actual positive change in terms of the production levels for our cotton producers thereabout.
Okay. Also, at the same time, it's important to note that our yield per hectare ranges at about 300 to 500 against an optimal level of about 800 kilograms per hectare.
Yes,
but perhaps what could be our potential moving forward? What could we do to actually get ourselves out of this?
There is a company that is looking to actually bring in hybrids in terms of the cotton seed, for us to have a better yield, which actually ranges in that area of 800 kgs per hectare, from the 500 kgs per hectare that we are currently experiencing. Now, this company, I'm sure it's called Cotton Seed Company, yes, and such kind of yields are very much favorable for us, because we would be looking at about 6 to 7 or 8 bales in a hectare over a span of about 1,000 hectares or so. You would get good numbers in terms of our cotton volumes.
Okay. Now, also of note is the fact that there is also another company from the south which has actually invested about $30 million, up from $5 million in the previous year, where they are actually looking to scale their hectarage for cotton from 20,000 hectares to 80,000 hectares, which I think would also see us increasing our figures and our productivity.
And that actually really gives us the answer to what I had mentioned earlier on, that we haven't had a lot of funding, we haven't had a lot of farmers in that area. Now, these guys obviously put in 5 million in the previous year. They witnessed what that 5 million actually could do for them, and they've seen the potential that is in the cotton industry in Zimbabwe, and now they do realize that if they put more money into the business, then they could get more. I mean, coming from a space of about 20,000 hectares, you said, to
80,000
to 80,000 hectares. That's a huge leap right there. That shows a lot of confidence and a lot of potential that is to come out of that. I mean, we have been currently earning about $60 to $70 million from the cotton industry. That should really scale up our numbers, if I did my research well, to about almost $500 million in terms of the value that we can actually attain from the cotton industry.
Okay, I also stumbled upon an interesting fact that what we are actually producing, whatever that quantity, right? We translate it to its monetary equivalent, but now that monetary equivalent could actually double if we add value to it. A statement says 90% of the lint is exported, but if you value add to the yarn, we double the earnings. Lint is currently fetching $1.50 per kg, while yarn is over $3 on the world markets, and this was a little bit earlier, some weeks back.
And then definitely you could see the trend in the guys that are actually making a lot of money out of this. Like I mentioned, India and China, these guys normally do actually trade more with yarn rather than just cotton products. Okay. And so these guys are making killings out of the cotton industry. I know for India at one point the cotton industry was contributing about 5% towards their GDP production levels. China has made close to about 200 million or more, if I'm not mistaken. I may have my figure wrong there a little bit, but these guys make a lot of money out of those kind of value addition programs that we haven't really endeavored into. So with funding coming in and with production numbers actually potentially going up and the hybrids coming in, then we could actually start talking about very good numbers that we could actually make from the cotton industry.
So I think definitely cotton is a commodity, is something to actually watch for where Zimbabwe is concerned.
Yes, I mean, when we were the breadbasket of Africa, you did mention that cotton was among the top two agricultural contributors to our economy, and it is very, very critical for us to deal with it in that manner, because if you look at the price at that time when we were trading such kind of numbers, I'll suggest it was a fairly good price, almost similar to where we are trading right now. But then the price as of late, you'll find that the huge cotton producers and importers and exporters, which are your China and your US, have had a couple of trade tiffs as of late. So that price hasn't been very much stable, or it has been actually humbled a lot because of that trade tiff right there. That hasn't been really resolved. So once that trade tiff is resolved, that market may actually come into a place where the price may start going up, because you'll find that Trump's administration is very keen on making sure that the agricultural sector of his economy gets enough value out of what they've done before, because it had been depleting. The agricultural sector of the economy had been depleting in the recent years, which is where most of his votes actually came from, because he did make sure that he did tame a lot of rural area, or rather communal area votes, because of the desire of that sector of the economy to actually begin to make as much value as they used to back in the days. Yeah.
Okay, quite interesting. Onto the stock market. Can you take us through the performance of the ZSE today?
The ZSE today was a little bit damp. Was damp again, very damp, I would say, which has actually brought the market to the first time where it is below its year-to-date opening levels. Now we are, like I've mentioned, we are almost 1% down from the year opening levels. All-share index is down 0.99%, and the industrials index is down 0.9% on the year-to-date Richter scale. Now, on a day-to-day basis, these two indices actually dropped 1.23% and 1.25% in that respective order for both of them, to settle at 144.75 cents and 488.71 points for both all-share and industrial index. The minings index was a little bit was in the green today. Came up 0.01% for it to settle at 213.20, adding on to its prior session gains. The top 10 index had a huge flop right there, coming off 1.47% out of the four indices. That was our hardest hit index right there, for it to settle at 141.66 points. Now, the huge mover within the top 10 stocks was actually Insco, that dropped about 3.05% for it to settle at 160 cents. While these guys actually did mention that they're raising their bread prices through their TA holdings, which is Baker's in. Cassava also led up about 2.37% for it to settle at 140.15 cents. Now, if we just to have a small look at our rises and fallers right there, we did have about 18 counters that traded on the stock market today. 3 of them were risers and about 8 were laggards, with CBZ leading that pack of bears by dropping about 12.39% for it to settle at 14 cents, while OK also dropped about 3.7% for it to settle at 26 cents. Insco and Cassava, we already spoke about those. One other top 10 counter there, which is Padenga, dropped about 1.75% for it to settle at 98 cents. Now, Old Mutual added an odd 0.4%, coming from a period where they've actually had been coming off a lot. Now, there is sentiment that the Old Mutual implied rate is actually coming to a place where it is almost divergent to the local exchange rate, which is at 2.5, and the Old Mutual implied rate is at about 4.1, currently coming off from as high as 6 and 5 times higher than the local currency. Now, with that being said, we should be seeing Old Mutual on a continued trend on the southward trend actually. If other issues then pop up, then that trend may be disturbed. But then as of now, there still is some contention around investors actually moving out of the stock market, going into the financial markets, more to do with the foreign currency market. So you would find that a lot of divesting has been happening in some of these top 10 counters, like you mentioned, like we've seen in Insco, Cassava and Padenga, for a lot of traders to actually push up their bank balances for them to be able to trade on the foreign currency market. Now, on a 5-day trend, I'm just going to give you a little bit of perspective here on how it has been performing throughout the week.
Again, the mining is in the green.
Yes, well, that is basically because of yesterday's uptick and also today's uptick as well. Now, it is with those two positive movements there, the miners index is now 3.04% ahead of its Thursday price, if I'm not mistaken. Today is Tuesday, yes. So it should be Wednesday price, which was at 206.91. Now, all-share index is down 3.07%, and also the industrials index is down 3.16%. Now, the graphical representation of those 5 days going back are pretty much explained right here with your small notch right there for your Friday gains that were actually experienced. Now, that's about it from me and the stock market.
Well, thank you, Anesu. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website www.EquityAxis.net. Good evening.